All right, well, welcome everybody to the Intequity podcast. Again, where investors, developers even learn how to get deals capitalized, how to get them structured. Basically, what does it take to get things over the finish line? How do you manage projects? And I'm really excited today to have John Bullman with me. John is a CIO. He's a CFA, CAIA, lots of acronyms, super smart guy with LGT Financial, where he oversees assets, does the financial investment philosophy, he does structuring, allocating. Historically used to be with Rosewood Investment for about 15 years and looked at all asset classes. There was about a team of five with a family office. I went to Baylor. By the way, my daughter wants to go to Baylor, and I got a little nervous after I saw how much tuition it was, and then SMU for his grad degree. So, John, thanks for joining us here on the podcast today.
Thank you, David, and I'm happy to be here.
Yeah, it's great. So let's start off. I just want to go through mindset, philosophy. When you look at an investment opportunity, John, what are the first two or three things you look at to go, hey, this makes sense or this doesn't?
So that's a great question, and I'm going to give you an answer you may not like, but it depends. Depending on the asset class, the structure you're investing in, the client you're representing, what's most important changes. So it's, for example, if you're looking at index fund, do you really care about more than the fee? Okay, but then it gets deeper, right? If you're looking for a private credit manager, you're worried about, how much leverage is on there, how much is PIK, what's the track record of that team? I'd say track record is always important, but then if you look at private equity, well, then that's a different story, right? So it's all about, it's your classic Venn diagram. I want the very best team. I want one with the best track record. I want it the best wrapper that fits what my client needs, whether they need some more liquidity, whether they need more or less, diversification on the inside. We're always juggling those things, and then I'll throw on tax efficiency, right? So some asset classes are very tax inefficient, where some are less so. But if you have a foundation you're investing for, who cares, right? But if you have a taxable investor, and I have a lot of those, well, you can't ignore it. It's been doing this for more than 20 years, and it's never simple. There's always a new wrinkle.
Yep, that's like when I ask an attorney a question, they're like, well, it depends, because it
Don't
does.
compare me to an attorney. We're not off to a good start.
But, context obviously matters on the situation of probably the client, their tax situation, obviously the asset types. Same thing on the commercial real estate side that we see too. So, do you personally, I mean, I'd love to just hear from you. Do you have like a set of guiding principles or maybe a mental framework that you typically go through on how you make decisions? I'd love to hear that, just
Sure.
your own
I
philosophy.
So absolutely, and I'll start off with every portfolio is going to have hot spots. What do you need? What do you lack? What could make it better? Some of that it goes in that it depends sort of idea. What am I looking for, right? So in terms of guiding principles and guidelines, I think one of the very freeing parts is there's a lot of really good ways to manage money. I bring my own philosophy to the table. Tell you about that in just here a second, but that doesn't make doing it a different way wrong. But for me, it is all about the allocation. That's my hedge. If I don't want too much equity risk, I just don't own it. I don't try to get too fancy about that. And then what I'm really looking for is a lot of different drivers of return and risk that will behave differently in different market environments. And so to think of it this way, if everything I invest in all has the same risk, let's pretend five different flavors of public equities, those are all going to trade down to varying degrees when we hit a recession. There's not any true diversification there. So that's what I'm looking for. So I'll own infrastructure, I'll own real estate, I'll own private equity, private credit, because I'm expecting them to build that very durable portfolio for my clients.
Got it. So asset allocation, diversification, that's a lot of what your philosophy is, just to make sure that ebbs and flows and you're not getting too volatile and hitting the portfolio too hard. Does that sound correct?
You nailed it.
Okay. And then going into like market sentiment, decision making in today's environment, what trends right now are you excited about? What in the market you're going, okay, because we're just in an interesting time. I mean, you've got a new administration, inflation is still hanging around. We're trying to figure out what the Fed is going to do. How are you navigating this, or what's exciting you, I guess, in this market, if anything.
Well, it's always way easier when you look backwards rather than forwards,
Sure.
right? So what I'm excited about, if I talk about an asset class, I like private equity secondaries. The dynamic is very simple where LPs haven't gotten distributions for a long time. So if, for example, a group hires a new CIO, what that person's going to want to do is going to want to make changes, right? He'll have or she will have her or his ideas about where they need to be allocated. The only way they can make changes in that private equity book is to sell it on the secondary market. So you have a combination of a lot of very high quality supply and good prices. So I like that trend. You mentioned the new administration. I can tell you something I'm not excited about is tariffs. I'm more of a free trade guy. But what that's playing into really is I think the Fed is going to have to keep rates a little higher for a little longer. And when you look at my public fixed income allocations, I'm entirely overweight that front portion of the curve. And you can see that the Fed meeting yesterday said, hey, we're going to hold rates steady. We're going to see how this new administration's policies, filter through the economy. I feel like that's the exactly right call. So if you can get paid north of 7% in floating rate bonds, pretty decently in high yield bonds, I'd take the money.
Yeah, that's good. I guess on the flip side, what's making you nervous? There's obviously the areas you can capitalize on right now based upon the decisions of administration and the Fed, but where are you going? That makes me nervous to even put my toe in that water.
So everything, right? You as an allocator, a friend of mine who happens to be a lawyer says he's a professional worrier, and I'd say that applies to what I do. Look, recession's always around the corner. Who knows exactly when or what form it takes, but I'd say, am I worried about that? No, I've tried to build a portfolio that will hold up decently well. But the reality is, if we're going to take some risk, if we're going to make some money over the long term, we have to accept that we're going to hit rough spots. We're going to lose some money over the short term. It's sort of like your choice. Are we going to stay in the harbor or are we going to be at sea? If you're at sea, well, storms will come and we build as best we can. But remember that investing has a host of unknown unknowns. And I'll give you an example. When we hit COVID, March of 20, global pandemic wasn't anything we'd experienced. We weren't looking for it. And then the market lost a third of its value in 3 weeks. So we can only prepare for so much.
Yeah, no, I remember that. It was just almost overnight, it just flipped off, and everybody thought, what's going to happen to the stock market? Obviously, went pretty low, and I think if you were a long-term bettor, we were like, probably a good time to buy once it gets
Agreed.
to the bottom there. Are there any sectors or classes of assets right now that you think are maybe undervalued, or that it's like this is probably a good steal right now, just given maybe some of the volatility?
So I don't think anything is super cheap. You can get to various things and make a case for it here and there. But let's just walk through your big asset classes, right? If you look at public equities, S&P is north of 20 on a forward times earnings. I think I'm always going to hold stocks if you want to talk philosophy. And I'll give you a great example. When you went to see here, 2023, something like 85% of economists said we're going to hit a recession. Take your 5% in cash and wait for a better buying opportunity. We all know what happened. The S&P was up 25, 26% in 23, a similar number in 2024. So that's one where I'm just going to own it. I'm going to accept that I'll have the downs, but I'll also get all of the ups. I don't try to make that too special. There's nothing I could say that we talk about private equity secondaries. It just feels like a back up the truck sort of a screaming buy. I do think you should stay invested. I think you should lean towards the income because that's the fat pitch. You get paid more for taking sometimes like senior secured risk than you've gotten paid in a really long time. So not to be on the bandwagon, but I still own a lot of private credit. I like getting paid 10%. My clients like that. Is it super cheap? No, but it's got a great income stream. And you think about it in terms of asymmetry. If we hit a recession, okay, some of those companies in the private credit world will run into trouble. There will be more defaults, absolutely. But you might find the S&P having traded off 20 or 30% while you're sitting there on a very modest loss in your direct lending book. So I'll probably say more than once, it's a portfolio for a reason.
Yeah, no, private credit is like the hot button right now, and rightly so, because you can get that similar risk for a lot higher return because, I mean, especially in the commercial real estate world. I mean, rates, guys that went in and bought apartments and they were paying 5% are now at 9.
Hmm.
and it's the same situation. Obviously, there's a tipping point of risk where you're like, okay, is this guy going to lose his shorts or not? But yeah, it's good. It's a good thing to know. What would you say? So, big mistakes. Like, what things do you see, like founders, sponsors, deal makers, when they're pitching an opportunity or coming to you? What are some big mistakes that you see people make over and over again?
Oh, man, well, my current pet peeve is when those who are selling private investments want to use all your traditional modern portfolio theory or MPT stats. So they're sitting here saying, "Oh, look at our correlation. Look at our low volatility." Well, of course it's low. It's private markets. It's marked maybe once a month, once a quarter, something like this, very seldom daily. And even if it is daily, it's not sentiment driven like the market. They're saying, well, we make, X EBITDA and we're going to mark that at 9 times. And so your volatility is the earnings vol of the company, not sentiment volatility in the market. So that's one that's very frustrating for me. In my mind, that's an apples and apples comparison, and it just doesn't make sense. If at best it's misleading.
Mm.
Can
How
you
does,
really tell me, as an example, REITs that own apartment buildings, retail, office, et cetera, those are more volatile. They act like small cap stocks, more volatile than the S&P. But when you put it in a private real estate product like a private REIT, all of a sudden the volatility is a quarter or a fifth. They all own the same things.
mm,
So as an allocator, I think it's very important to understand the risk you're actually taking, not just what's on the cover in terms of that historical volatility. You talked about big mistakes. Historical volatility is not always predictive of future volatility.
yeah, that's true. How do you get into that? That's a really great point on determining risk. Do you look at it like, for example, and I'm only speaking from my world that I live in, which is real estate. I'm going through all these steps of saying, okay, like for example, we're doing a deal right now where guys building, this building up north, and I'm saying, okay, you got construction risk, right? And so we're walking through those conversations of even the contractor. This could be an issue. The budget changes. This could be an issue. Walking through the elements of the deal itself. Do you look at it as the isolated risk itself, or are you looking at in the total picture of the larger scope of that particular segment of the economy that they're in?
So I think that's a bottom up and top down question. And the answer is both. You want to invest in the best markets with the best managers you can find, right? So some of those are top down concerns. Is now a good time to own whatever it may be, especially if that's one of those asset classes you're happy to rotate in and out of. And then from a bottom up point of view, oh yeah, you have to dig in. You have to understand, were they lucky or do you think they have skill? And that's, I'd say, one of the very hardest ones to figure out. But there's some telltale signs. If they've got a great 5 year number, but that's because one year happened to be amazing, well, then you're betting they can pull that off routinely. Maybe they can, but that's the bet you're making, right? I'd prefer someone who adds value more consistently. Now, on top of that, if you think about active versus passive, equities are tough. Look at the numbers. Something like 95% of active managers underperformed their benchmark. I've played that game for 20 years. I can't say that I won. Some great picks, some that were not so great. So I tend to index the beta and just look for the alpha and the diversification on the alt side.
And how do you, when you look at the manager, for example, is it for you, is it, hey, I've got to know that you've done this for a certain period of time, and then that you really shown a track record to be able to successfully look at doing that? Or what are some of the elements that you look at?
So track record is huge. And I think less so from is the number X or Y or, higher or lower, but I'd say it helps you frame your expectations. How will this strategy perform in different market environments? Because when my expectations are framed appropriately, it might be perfectly fine for a manager to lose 20%. Let's pretend you're doing, biotech stocks or something like that because you think they can sometimes do 30, 40, 50. Okay, fine. Maybe that's a good bet to make. However, that would be a giant red flag for other strategies, right? So understanding, hey, what's the band of outcomes that can either on the downside or the upside
Hmm.
Okay, what do I expect? And it's funny, but if a manager does way better than expected, you should dig in. Then you didn't understand something about their strategy, or they've changed it and they're taking way more risk and they've gotten lucky.
That makes sense. Yeah. I'm sure there's a lot of factors that go into determining who you're going to deal with on the management side. How much would you say?
I hate to simplify it, but it does sometimes come down to faith. You're investing with people, and like any other relationship, who do you want to trust? In this case, with your client's money. And you know what? I tend to go for the biggest and the best in a lot of cases. I know any investment I make can hit a rough patch. That service has to be there. That explanation has to be there. And also, I want them to have the staying power. So I tend to avoid those smaller boutiques that live and die by, a couple quarters of performance for any one product.
Yep, got it. And how much of what you do would you say from an allocation perspective, and maybe even today, ends up being traditional equity markets versus alts? Like how much do you allocate typically into alts versus just traditional bonds and stocks?
Okay, well, sometimes I'm afraid to say, but I'll run a 50-50. All equities and fixed income on the public side and
Yep,
cash at
yep.
half, and then the other half on the alt side. And what's happened, especially in the more retail world I'm in now, is the just explosion of evergreen products.
Hmm.
So you can invest with, pick your firm, Blackstone, Apollo, KKR, it goes on and on, Stepstone, Ares, Lexington Partners, Carlyle, but all in a wrapper that a retail client can own. So you're not compromising on the quality of the firm. It's like we touched on earlier. They have a structure now that makes sense for a person's IRA or their other sort of retirement assets that they have. And to me, that means your retail investor can invest really no differently allocation wise than we did when I was running the family office team.
Yeah. Are you seeing a lot changing in the alt world in terms of, democratization, access to it now, liquidity? Like what are the things you're noticing and where do you think we're headed when it comes to the alt space?
So the answer is just a definite yes. We are democratizing alts, and so if there's a concern, it's a lot of these structures haven't been tested yet. So there's a chance, and I'd say there's a certainty that some are going to hit hiccups, and there will be a learning process there. But I gotta say, I love it. I think it's a fantastic thing, and I do think that these evergreen products will take a larger and larger piece of the market. And that's really for a couple of reasons. One is, say you're starting a drawdown private equity fund program. If that's all you do, you won't hit your allocation target for 5 or 6 years. And at which point you're under allocated to one of your higher performing asset classes. Or you could put all that money in liquid alts and have that exposure today.
Mhm.
So maybe you give up some in terms of IRR, but I'd argue your multiple, since you have more dollars invested for longer, it might even be better. But the real peanut butter and jelly of this whole thing is combining them both, right? There are scenarios where a liquid alt's more appropriate. There are other scenarios where, hey, you know what? There's some great drawdown funds in the market and we should allocate to them because we have that time horizon and that risk tolerance.
Yeah, I was asking someone the other day about, where are we going to be at in 5, 10 years on the alts? And he's like, it's infinite, the amount of things that are happening with liquidity in it. So
Well, I'll give you another stat. Most advisors, they hold maybe 5 or 10% in alts. So whereas your endowments and your foundations have a much, much higher allocation.
really,
Yes, so I see that as advisors get more comfortable, as the product selection continues to improve, then these percentage in portfolios, I say I do half today. Some people feel like that's a crazy number. I think those are going to come up, 25, 30%. I may very well be the norm in a few years.
yeah, no, that's good. And then when somebody's coming to you with an alt, how do they come to you? How do they show up? What's the best way for people to show you an alt deal? Like what's that? Because I know you obviously there's the Blackstone, KKRs, Apollos of the world that just probably has their reps, but do you ever even look at anything outside of that and consider it? And if so, what makes you go, that's worth looking at?
So there's a lot there. I prefer to hunt rather than be sold to.
Ah,
So
like that.
um, that And that is very much where I'm starting. Like right now, I'm looking for an opportunistic credit manager on the private side. They can have some public securities, but I'm like, okay, what am I thinking about? I have a portfolio of other managers because I want my new manager to bring something new to the table. I'm looking for that diversification. I don't want it just to be manager A and manager B who do the exact same thing. So now I'm looking for something very specific that really only applies to me because I have a portfolio that looks the way I've built it, right? But I'd say on a client by client basis, you said, hey, do you always go with the big guys? The answer is for a small client, yes. Now, as you get bigger, as you can, will we still own those big guys? Yes, absolutely. But now when you have more dollars, you can do some of these nichier things, some of these things you maybe don't plan to hold for a long time. And I'd say private credit is more of a trade. I don't know that that's one I'm going to own forever, but I'll certainly own it while it's going to pay me 10%.
Yeah. Yeah. That's good. And then how do going back to you allocating, managing, diversifying, how do you prepare for volatility or downturns in portfolio? Is it like, are you looking at it frequently and saying, hey, we need to, I'm thinking the tea leaves are looking like this. We're going to shift the portfolio, or what's your personal philosophy on how you're trying to deal with the reality of downturns, volatility?
So it goes back to the earlier point where I want to build that allocation where my max drawdown is acceptable for that client.
Got it.
So if I'm way over my skis risk wise or allocation wise, to me I haven't done my job. So that is my primary hedge to that. But now you're really talking about tactical allocation. So I divide that into two buckets. I'm not generally going to change that overarching allocation unless something changes dramatically with the client or with the markets. But underneath that, okay, say for example, their target will say we're going to have this much in public fixed income. Well, what does that look like, right? So that's where I tend to make a lot more of those shifts. And I'll give you an example. When we were early 24, at one point the market said we're going to get, I think I'm not making this up, 6 rate cuts. I think it peaked at that. I'll be honest, I just didn't think so.
Yeah.
I didn't think that was on the table, but that's how the curves were priced. And I wish I could say I moved the market. I do not. So when I looked at that, I said, you know what? I'm not getting paid anything to own these longer term bonds because of market expectations, right? The curve reflected the idea that the rates were going to come down a lot. So I stayed on the prompt end in some portfolios owning 100% floating rate bonds. And you know what? We ended up with a couple of cuts. So that's one that worked out.
Yeah. That's great. And then what about, I mean, I have enough gray hairs to have the wisdom wounds of time. Any hard lessons you've learned and deals that was like, man, that was a good lesson that left a good sting in me.
Yes, this is an older story, but I'll go back to the financial crisis here. And so I also have a few of those gray hairs myself. So I remember, and this is when I was at the family office, post Bear Stearns, but pre-Lehman, I did a levered bank loan deal. These things had traded down to 90. This was unprecedented, circled up all my wagons and pitched. And I think I'd been at the firm about a year at that point. Of course, everything goes great until Lehman happens. And what we thought was a bargain at 90 traded down to below 50. And on top of that, they pulled my swap right in my total return swap right in the middle of that. And I had to then go back and get more money to bail out the deal I just pitched as being low risk. So, so many lessons. One is stay humble. You can, no matter how well thought out you think you've got it, the market can have a surprise for you. And then the point I made earlier, the historical volatility on those loans was nothing, and then it all came at once. And that's what I think about when I'm investing in any alt. Is it doesn't that historical vol doesn't matter. If I'm taking enough risk to have a material write down, that's the risk I'm taking.
Yeah, it can happen fast. I remember that too. I mean, the market just. I remember getting phone calls from a large loan that we had just gotten approved, and the lender called and said, we're not doing the deal. And I said, what do you mean you're not doing the deal? I said, you approved it. He says, I don't care. We're not funding them. So it's amazing how fast things can shift in a market. So,
Agreed.
yeah. Let's talk about big picture AI. Look, everybody has their own opinion on AI. It's here, it's in our face. Whether it's an over narrative or not, there is a component of reality to it. How do you look at AI? How do you see it impacting investment, landscape philosophy? I'd love to just get your own perspective on.
So there are so many experts on this, but I would defer to them. But I see it really as two parts. One is, does it increase productivity? I'd say that's a yes. I don't know if you've ever used ChatGPT or Copilot, you're right. And when you can get more data more quickly than you've been able to before, that is a fantastic increase in productivity. So I like that. From that point of view, bring it on. That said, it's going to displace not just call it your blue collar workers. You can worry about truck drivers and other things, right? White collar workers. Another friend is employing it in his law practice and finding that he gets better results in what used to take a couple of weeks now takes a couple of hours in terms of some of these processes, especially when they're getting ready for a case. So what does that mean? So for an economy as a whole, look, there can be some winners and losers here.
Yeah, I agree. Yeah, I've used ChatGPT almost daily, and it's unbelievable. You put a contract in there, you ask the right questions, it literally rips through it within 15 to 20 seconds and gives you all the information. And I did say that to my attorney friend. I said, "Got to be a little concerned about that when you charge quite a bit of money for contract reviews that can be done." So it's a real thing. So when you look at you know best piece of advice that you've ever received about investing from mentors, people that you've worked with in the past, just your own experience. What's that been?
So uh, it's a little bit maybe different than advice, but one of the things I realized, I say, if we talk about biggest learnings, is when I was a young man in a freshly minted CFA. I really thought it was my job to make good numbers, and then as I've learned, the number itself is usually not good or bad. But it's the reasons why. How well do you know your portfolio? How well can you tell that story? How well can you make someone comfortable that maybe even though things haven't gone their way, there's a plan in place that makes sense. So it's really more a story about knowing your stuff, having conviction, but realizing that it's not just the numbers. Your people aren't the people, my clients, they aren't computers. They're people, and they don't like losing money. They have their needs. They can get afraid. And generally speaking, the most value I can bring is not usually some great allocation. It's keeping people invested when times are hard. Because behaviorally, what do we all want to do? You are wired, all of us, not just you, all of us are wired to buy high and sell low, but that destroys value.
That is so true. There's this fear inside of us that starts wanting to run as soon as everything drops, and it's probably as Warren Buffett says, run towards it when everybody's running away. So I
Be
think it's
greedy when others are fearful.
yeah, it's true. Got to be careful too, I guess, depending on the timing. So if you could go back and give yourself one piece of advice, right, at the start of your career, what would it be?
I don't
Knowing
know.
what you know
Start a plumbing company, maybe that won't be replaced by I'd say, and part of my story here, I went through a stretch where I was just in between jobs, and I had to rely on the graciousness of all the people in this business to, give me introductions and hear my story and help me along my way. I can say I overemphasized the technical aspects, and for the bulk of my career, I didn't build the relationships and that I should have. Now, thanks to there being just a huge number of fantastic people in this business, no one held that against me. And then, and it's one of those introductions that led to LGT creating this role for me a year and a half ago. So the advice would be is, you know what? Stay out there, make a lot of good friends, have that network because the day will likely come. Maybe you don't need it, but you can help someone else.
it's good advice. And for LGT, who do you work with specifically? Is there a certain segment that you focus on at LGT?
So, not exactly. If we're talking about clients, and most of our clients tend to be business owners and who have a broader relationship with the firm. I didn't mention, but LGT does tax and audit and other accounting work as well. So it's really that synergy between the financial advisory team and the broader firm that allows us to bring more solutions to our clients.
Yeah, that's great. Well, hey, I just want to thank you for taking the time to come on today. I know you got a lot going on, and it's just always helpful, especially with a lot of your wisdom, insight on how do you invest, how do deals get done, how do they not get done, and good lessons that we could all learn as we go through it to collect a lot of wisdom and to be humble as we recognize things don't always go as planned. So thank you again for jumping on to Intequity today.
I appreciate it, and thank you.
Yeah.